Hey everybody, if you're an investor like me, you're probably wondering whether or not we're in a bubble. Now I can care less what type of asset class you're looking at, whether it be stocks, whether it be bonds, whether it be real estate. These prices are reaching stratospheric levels, and normally when this happens, it doesn't end well. So have we entered a bubble? I don't know. But what I'm going to try to do is explain to you, number one, what a bubble is. And number two, are we there for, stocks? Are we there for real estate? Are we there for bonds? And what you can probably do to get ahead of it. Stay tuned. If you've been watching the news lately, you've been hearing a lot of commentators, you've been seeing a lot of reports about whether or not we're in a bubble, whether it's real estate, whether it's stocks, whether it's bonds. And what you want to realize about a bubble is when an asset prices really increase in a short period of time to really unprecedented levels. The reason why is because usually there's an increased amount of demand, there's not that much supply, and the price goes well above fundamentals. And when a bubble forms, it's unsustainable, and then eventually it pops. When the bubble does pop, asset prices crash, the supply for whatever was in demand before goes way too high, so nobody's asking for it anymore, and the economic consequences are real. One of the most popular ones in terms of bubbles that I can remember is tulip mania. That's the one that happened in Holland back in the 17th century. So in the 1600s, for some reason, everybody was infatuated with tulips. I have no idea why. But depending on the type of tulip that you had, you can make a considerable amount of money. One tulip, for example, could buy you a house. It could buy you land. It could buy you groceries. It was insane. In fact, there was one bulb in particular, one tulip bulb in particular, that had like a yellowish, greenish view, whatever it was. But that one bulb could have bought you 2 houses, 3 boats, farm animals, and the land to service the farm animals. One bulb. So as you can see, it went way out of hand, and then it popped. When it did pop, everybody who was invested in that area of tulips, everybody who built a business around that area of tulips, lost all their fortunes, basically overnight. Now that was happening in the 1600s, but some of the most current ones in our own environment, think about the real estate bubble in 2008. Everybody was a real estate investor, everybody was a mortgage broker, and then in 2008, it crashed. Those of you who were around during the 2000s, everybody and their mother was investing in tech stocks, right? Technology, the internet was huge at that time in terms of just potential. So, you just add .com to your name or tech to your name or whatever it is as a company, and your stock price ran through the roof. Well, in 2000, that came to a head, and then it popped. People lost their jobs, went into a recession, and a lot of companies and people lost their money all over the place. So the reason why I want to explain that to you is because once you know what a bubble is, you can start to prepare yourself from an asset class perspective to see, all right, what can I do? So we may not be in those really extreme environments, but you can tell that something's not right. Something is not in the real realm of what's supposed to be going on in terms of supply and demand. So what I'll talk about in the next couple of sections is, are we in a bubble for real estate? Are we in a bubble for stocks? Are we in a bubble for bonds? I don't know. Okay, so let's start with stocks, for example. Are stocks in a bubble? Every day you hear about the market reaching new highs, irregardless of what's going on in the market. So take a look at these charts for a second. Let's start with Google. Google has basically doubled its price since October. Doubled. You can have a 100% return if you invested in it since last October. They're not the only ones. Take a look at Tesla. Tesla's exactly the same thing, basically doubled since last October. Now, if you're a long-term investor like me, chances are you have a good portion of your portfolio in an ETF or a mutual fund that just tracks the market. The S&P 500 has more than doubled since the lows of March 2020. Now, when those type of prices are kicking in, when they're totally divorced from the underlying fundamentals of the stock, you may think that a bubble is looming in the horizon, right? You know something, it doesn't make sense. When you can take a dart and just throw it at the board and every single stock is going up, that's usually a problem. Now, why is this happening? Several different reasons. The first is that the actual government, right, our federal government, the Federal Reserve, for example, has been pumping money into the system, whether it be through stimulus, whether it be through bond purchasing from the Federal Reserve, whether it be through the extra unemployment checks that the government sent out. They've been pumping a ton of money into the system, which has turned around, and all that money has started going into the market. Now, the second thing to consider is that we're at very low interest rates, so people cannot get the same type of return on a bond that they could in the market. So what do? They take their money out the bond market and they move it into the stock market. So that's why everybody's buying at the same time. The third thing to consider as well is not only do you have institutional investors who have been investing in this, but you have a record wave of new investors, these new individual investors, for example, who've just started coming into the stock market since, 2020. And that's great, but when you put all those people in there at the same time and they're all buying the same assets, right? All these tech stocks, for example, if they're all buying the same thing at the same time to the point where the prices are above the fundamentals of the stock, you may have a bubble. So you need to see some caution here, right? Caution should be shown at these levels. The problem with a bubble is when you have people like me tell you that, let's say, for example, stock market could be in a bubble, the hard part is predicting when it's going to pop. And to this point, most people can never do that. So what I would suggest is you continue to invest, right? You continue to put your money to work. But if a bubble were to pop, right? If this whole money stimulus that's in the market right now was just taken out and you just allowed the asset classes to fall, how would you react? How are you going to be prepared? So maybe putting a little bit of cash away slowly but surely while you're investing so that you have money on hand to buy when stocks drop, whether it be 6 months from now, a year from now, or 2 years from now. That would probably be the best route, right? Don't try to just go to all cash and just sit. Doesn't make any sense. But in my opinion, if you are going to go in the stock asset class at this point, put some cash aside so that if the market were to drop, you can take advantage of the dropping prices. So what about real estate, right? Is real estate in a bubble? Well, you probably know someone, either your friend, your family, acquaintance, coworker, whoever, that has bought a house within the last year or year and a half. And if you look at what they bought, right, chances are they can tell you horror stories. They had bidding wars. They bought a house that was probably 20% higher than the asking price. They had insane competition. People coming in just throwing cash at a house and saying, we're going to buy it all cash. They took larger mortgages. They took larger house payments than they actually had part of their budget. And if you look at it from a statistical perspective, year over year, prices have increased for houses almost 18% on top of already what was happening last year. So the market is definitely overheating. Now, why is the housing market overheating the way it is? Now, there's several different reasons, right? Let's start with economics, for example. Demand, supply, right? Those are the key aspects of economics. Well, what's happening in real estate is that you have a large amount of demand with limited supply. That's what's going on in the housing market, right? So you have everybody looking for a house, but there's not that many houses for them to buy. And the reason why is because during the pandemic, there weren't houses being built. So when all this demand kicked in and there wasn't a limited amount of supply, prices shot through the roof. Now, on top of the housing prices in terms of demand and supply, you also had supplies that go into the house, right? So everything that costs to maintain the house, to build the house, all of that increased because there was a large amount of demand coming out of the pandemic to build houses. On top of that, you had people who were able to work from home during the pandemic, and they started to realize that they have a little bit more job flexibility now. So what people did, instead of being cooped up in an apartment like this, they went and bought a house. And not only did they buy the house, you're going to love this, they bought the house at historically low interest rates. It was the perfect environment to have this large increase in prices. So that's what you got to really understand in the real estate market, is that this is the perfect environment for housing prices to go through the roof. Literally everything, literally everywhere that you look, housing prices are going astronomically high. So here's my suggestion. If you just bought a house and you're happy you have the house, fantastic. Go over your budget and make sure you can afford the house, right? You don't want to buy too much house that your budget can't sustain. So you want to go through your budget, make sure you can actually do it. If you are looking for a house right now, make sure that you're putting a little bit more of a payment in your budget, because there's going to be a very good chance that you're going to pay more than it, whatever you budgeted. Now, is it a bubble? In my opinion, yes, I do think this is a bubble at this point, because housing prices cannot increase. If you don't believe me, just go back and look in '08. Right? '08, everybody was buying a house. Everybody was a real estate broker. Everybody was flipping houses. And then it popped, right? And it sent, us the great recession, right? Did you read in, the books or whatever that happened during that time? Housing prices crashed. Everybody was losing their job. The market crashed, everything. So I do think that it's severely in a real estate bubble. I think you need to prepare. If you have a house right now that you're starting to feel like, this is a little bit more expensive than I want, I think you should cut back on your expenses, try to figure out a way you can afford the housing. So, and just in case, if God forbid you lose a job or some, real estate market starts to go left, you're able to sustain the house. But is real estate in a bubble? In my opinion, yes, it is. And what about the bonds? Now, I know the majority of people who are watching this video probably don't invest in bonds, but you should know whether or not you think bonds are in a bubble, just because it can affect other asset classes that you're invested in. So at this point right now, the Fed has kept the interest rates on bond artificially low, and it's been that way for a pretty long time. What you need to understand about bonds is one key relationship that took me a very long time to understand. But it's basically this. Bond yields and prices are inversely related. So what I mean by that is the interest rate that you earn on a bond, if that goes up, prices fall. If interest rates on bonds decrease, prices rise. So what you're seeing now is that as these interest rates have dropped, the prices for bonds have gone high because people keep buying more and more bonds because they can't find safety anywhere. And think about people who are retired, right? If you're at the age of 65 or higher, what you're probably doing is putting your money more into fixed income instruments because you want income, right? You want the steady income. You don't want the price fluctuations of the market. Well, because these interest rates are so low, retirees can't really put their money in the market the way they want, and the bond market, that is, so they're putting their money into stocks. But even if they want to stick to the bond market, they're pushing up these prices higher and higher. So if you look at some of these bond prices, some of the highest bond prices we've ever seen in the market. Another area of concern, though, is a lot of companies took on debt, especially during the pandemic. Remember, interest rates are low. So right now for corporate, America, for example, there's $10 trillion in debt. I don't even know how you could put your mind around that number. But $10 trillion in debt in, the economic society of all these companies. And the reason is because interest rates are so low. Now, here's the problem. If you've been watching the news, if you've been reading and all this kind of stuff, you're hearing about the Federal Reserve trying to figure out whether or not they have to raise interest rates. Why is that important? Remember, I told you the inverse relationship. Once you start to raise interest rates and you have debt, if it's a variable debt, right, if your debt fluctuates with the amount of the interest rate, what happens is that as rates rise, debt gets a lot more expensive to service. There's $10 trillion of debt in the system. If they start to raise interest rates, it's going to cost a lot more money to service the debt. On top of that, if interest rates do rise, then a lot of people who have their money in the market are going to take it and throw it into the fixed income market because I can get a higher interest rate with less volatility. So that's why you probably should care about the bond market, even if you don't invest in the bond market. It's because as these interest rates start to rise, they're not going to stay this way forever. But as they start to rise, bond prices will fall. And as the interest rates start to rise, people take their money from the equity market and they move their money into the fixed income market, which means that the equity market will start to drop. The other thing to consider is if interest rates starts to rise, that means that the refinancing on houses and all these types of things, the interest rates you get on your mortgage, for example, will also start to rise, which means you'll start to see people buying less and less houses. And unfortunately, if that happens, that could be another bubble that pops as well. So that's why you should care about the bond market. So are we in a bubble? In my opinion, yes. And not only are we in a bubble, we're in a bubble in all three asset classes: stocks, bonds, and real estate. If you look at what I just explained to you, right, you have the Federal Reserve that's keeping the rates low. You have the federal government that's pumping in a ton of money, and you have a cheap cost of borrowing. When you have all three of those things together, that's why you got all three of these asset classes raising at the same time. The problem with a bubble, though, like I mentioned before, is that you never know when it's going to pop, right? So if you have someone on Instagram or you have someone on YouTube basically telling you they know when the bubble's going to pop, they're lying. They don't. So my advice is to make sure you stay invested, right? Because if you're a long-term investor, even if you go through several bubbles, at the end of the day, you're still going to have appreciation on your money. But you need to figure out, maybe is now time to put some money aside just a little bit so that if the bubble does pop, I can take full advantage. It could be next year, it could be 5 years from now, who knows? But I'll leave you with this nugget. History not only repeats itself, it also rhymes. Things start to look the same year over year when you start to look at it in a long period of time, because we tend to make the same mistakes over and over and over again. So like I said, put some money aside, take advantage of the bubbles when they pop. I'm debt-free Joel. Feel free to find me on Instagram and on YouTube At Debt Free Joel is the same name for both different areas. And I'll see you next time.